What it do, YouTube? I'm Ace Palomero, South Texas Realtor, proud son of the Rio Grande Valley, and fallen Starbucks angel. Welcome to my channel. In this video, I'm going to be talking about the Fed funds rate, mortgage rates, and the saying, marry the house, date the rate. Let's get this rolling. The federal funds rate is the rate of interest that banks charge each other whenever they lend money to each other. And whenever they lend money to each other, it's usually very short term, like an overnight basis. And the reason why they have to borrow money from each other, lend money to each other, is because by law, they have to keep a certain amount of their total capital on reserve. Whenever the Federal Reserve raises or decreases the Fed funds rate, it's one of their tools, if you will, that they use to fulfill their dual mandate of keeping the economy stable and keeping as many people as employed as possible. Last week, the Federal Reserve raised the federal funds rates by 25 basis points, or quarter of a percentage point. Let me actually read you their official statement. This is from July 26. Recent indicators suggest that economic activity has been expanding at a moderate pace. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Right. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risk. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 5.25% to 5.5%. The committee will continue to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, as described in its previously announced plans. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risk emerged that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. That was a mouthful, huh? Alright, so what I took from that, the quick and dirty, is that the Fed's goal is to get inflation down to 2%, yeah? But inflation is still just under 3%. And the employment rate, or the unemployment rate, is still too low for them to reverse course. The unemployment rate is actually at, 3.6 right now, at least from June of this year. And it hasn't been that low since, December 2019, so pre-pandemic. Unless unemployment gets crazy, or unless we hit that 2% goal that the Fed has set, I don't see why they would reverse course and lower the Fed funds rate again. So for anyone that's being told, oh, the rates will be coming down, it's like, well, why? And when? Alright, let's talk about mortgage rates. So this is from bankrate.com, and this was actually written today, August 2. Average mortgage rates increased for all types of loans compared to a week ago, according to data compiled by Bankrate. So rates for 30-year fixed, 15-year fixed, adjustable rate mortgages, and jumbo loans, all of them increased. Uh, if you just look up mortgage loans or mortgage rates, like on Google, like Google has its own calculator, and this is based from August 1. So Tuesday, if you input like let's say 30K for the loan amount, right? So that's not the price of the house, that's the loan. 20% down, state of Texas, with a credit score of 707, between 700 and 719. The average 30-year fixed is 8%, just over 8%. How much does a difference of 1% in your mortgage rate affect your monthly payment? I am in mortgagecalculator.org right now. This is the website I like to use whenever I'm talking with my clients about their monthly payments. Same that includes their mortgage, insurance, HOA fees if that applies, as well as the benefits of making extra payments a month towards their principal. I like the way it's set up, the way it breaks everything down. So let's assume I'm actually going to use another property. So I just got a notification that this property had a price decrease today. Actually, it went from $399 to $369. This is a single family. It's out in far. Let's put the value at the $369. Let's assume that we make an offer on it, right? At their now new asking. Let's assume 3.5% down. FHA loan. Let's say we got 7%, right? 30 years for the loan term, and the property tax. It says that it's 8,270, but we know it's going to be more than that because that's based off the assessment of the 324 or 3,000 or 324,000 in the county records, right? So if we're doing it by the percentage of that, it's property taxes is about 2.5%. So 2.5% of 369. Taxes will be about 9,200. So let's just put that. Let's round up. Let's just say your PMI is going to be 1%. Home insurance, I believe it's anywhere from 1,000 to 1,500 McAllen right now, at least according to what is it? Plan for Freedom, right? Let's just put 1,500. And monthly HOA fee, so 480 by 12, it's 40 a month. HOA fees really only go up, let's say 50 a month. And let's calculate it. So if you bought this house at the new asking price, you would be paying a total of $3,611.61 a month. Let's say the rate goes down, or you can get the rate down to 6%. Drops it by just over $200. Let's say it's 8%. It increases by about $200. So for like the minimal down payment, it's about a $200 difference. Marry the house, date the rate. This is something that I've heard more than a couple times in the past year or so, ever since the mortgage rates went up. Basically, it's a way of saying that you're not necessarily tied down to your mortgage rate and that you can always refinance later. That's another thing I hear a lot. You can always refinance later, which I think is a little bit reckless, especially when it's being told to you by somebody who no longer has stake in the house payments, unlike you. I don't know. I think the better way to think about it is that yeah, the house is the person that you are marrying or considering marrying. The location, area, the size, like the minimum or maximum size of the lot. These are basically the non-negotiables of which you look for in a long-term relationship. So, like whether or not you want kids, your shared beliefs and shared values, the specific location, the exact number of rooms, like bedrooms, bathrooms, the size of the kitchen, whether or not there's like a dedicated living room or dining room, number of cars that the garage can house, nearby amenities. These are the things that you're getting in this or getting from this long-term relationship. And the price and the rate, these are what you're giving up for the relationship. Like, yeah, the whole marry the house, date the rate, that's a little reckless. Same thing with the you can always refinance later kind of mentality, because that seems to assume that rate is the exact or close to the exact same importance as price for when you're considering purchasing a house. For me, price is more important. You can't renegotiate price, while you can always go back and refinance and change that rate. A lot of people neglect to think about the cost of refinancing. It's about 2.5 to 5% of the value of the loan. So you do need to have that ready to if you want to refinance. You also need to have a certain amount of equity in the loan if you want to refinance. And refinancing is essentially paying off the old loan with a new loan. So you also restart the clock on your mortgage. And in case you didn't know, the way mortgages are set up is that most of your monthly payments, the majority of it goes towards your interest for the first 10 years and even more. I don't think you start make your interest payments and the payments towards your principals, they aren't equal until about year 20 for a 30-year fixed mortgage, if I did my my rounding up right. So yeah, rate is not the same as the price, or not the same importance as the price. Like price, like it's basically like, yeah, price is you can't see other girls anymore, and rate is like, yeah, sometimes she steals my hoodies. So price is way more important than rate because you can't go back and renegotiate that price. That's it for the video, guys. Key takeaways: the Fed funds rates just increased last week. They're probably going to increase it one more time before the year is out. At least that's what they said back in June. Meaning mortgage rates probably won't be coming down anytime this year. Mortgage rates shouldn't be the only thing that you're looking at when you're considering a real estate transaction, though. I think the most important thing, or one of the most important things, is price, and that's more important than the rate. The saying, marry the house, date the rate, in my opinion, is a sloppy saying. And that's it for the video. If you found any of this information valuable or useful, or if you found my metaphors entertaining, like and subscribe. Bye.